Okay, so today's agenda is to finish up um, this new way of analyzing policy. The reason why we're doing this is because we want to understand the relationship between E versus Y, right? We want to know how uh, the exchange rate can cause increases or decreases in output or national income. And the insight, of course, is because E is influencing the current account, right? Trade commodity flows. So we spent some time modeling the real side of the economy. We built something called we brought something called the Keynesian cross, right? Something that allows us to model demand and an economy, demand and supply in an economy, how equilibrium is achieved. And we linked that real side of the economy with the financial side, right? As represented by uh, money market equilibrium equation along with UIP, right? That's the representation of the financial markets. So maybe before talking about policy changes, let's just review a bit about how it's constructed and how equilibrium is achieved, the steps to achieve equilibrium. So, all right, so we stopped here yesterday. So maybe it's good to review a little bit. So I'll start over, of course, right? So the last slide that I was on last week was the following. I was plotting E versus Y. And I was representing the real economy with what's called a DD schedule. It's called a DD schedule because it's supposed to represent all combinations or schedules of E and Y that allows market clearing in the sense of real goods and goods produced equals real supply of goods produced equals real demand for goods produced, right? Or just, yeah, actual goods. This line can be summarized with an equation. It's Y equals D, and then we focus on the following parameters: disposable income, investments, government spending, and of course Q. Right? And we learned that basically all these inputs, all these parameters are positively related with output because it's just representing spending and investments, right? Public and private. And then we have this import export stuff, which is again, a representing of expenditures, but from abroad, right? Spending on our goods and services produced. The idea again here is if D changes, Y will follow, right? If D increases, Y will eventually increase. If Y decreases, Y will also eventually decrease. The financial side, we're very, very familiar with. We're just compacting, making the short-term model more compact, right? So the AA schedule, again, it's called a schedule because we're looking at combinations of E and Y that achieves equilibrium in the financial markets. This is represented by the following equation. MS over P equals to L. And then now we replace R equal to R star plus E hat E minus 1 and then Y, right? We're combining two equations into a single equation, and that just makes things more condensed, right? We don't have to think about shifting curves in that term T graph, right? We just focus on just this single axis graph, a single Y and single X axis. All right. Equilibrium is when the two schedules intersect, right? It's a combination of E and Y that clears markets everywhere. All right, the mechanism in which we restore to equilibrium, the thought experiment is the following. You just say there's an arbitrary shock that makes us out of equilibrium everywhere. So I chose this point arbitrarily. This just means that we are here in which there's an output shock, right? And also we are no longer on the A schedule, which means that we are not in equilibrium everywhere, right? In the financial markets. intuitively, the first thing that should occur is if there's a mispricing, such as this here, it should be corrected immediately. Financial markets are efficient, so anything that's mispriced will be corrected instantaneously. So this dot will instantaneously drop onto the A schedule here, right? Y doesn't change yet, right? So for this given Y, this E is too high. So carry traders will conduct their carry trade in such a way that pushes E down, right? So here's E prime, and this is E2, E double prime. Okay, so here we are in equilibrium in the financial markets, but we are not on the DD schedule. So the real economy is not in equilibrium. Why? Because at this given output level, equilibrium says E should be down here. So let's write E triple prime here. So as long as E double prime is higher than E triple prime, then that means that aggregate demand is higher, which means Y wants to increase. So we're moving in this direction. To see that it's moving along the A schedule, just bring this increase in Y to here, right? Increase in Y means liquidity preference also increases. To restore equilibrium, we have to find a way to decrease that, which means that R has to increase. To increase R, we can decrease E, right? So this is the final step. So E shifts down, but if the E is still higher than E triple prime, we will always continue to push Y upward, right? So that's why we're moving, we keep moving, it keeps looping and looping and looping and looping until all markets clear, right? This is the only stable point in which every market is happy. No more supply is created, right, in response to increased demand, and everyone's happy here, right? No more carry trade, no more interest rate differential to exploit. Expected returns on carry trade is 0. And yeah. And Y isn't changing either, right? Because Y is stable. So that's the idea. So we're going to use this mechanism now to analyze policy shocks, policy changes. Comments, questions on the review? Okay, so the first thing I'm going to focus on, just like before the midterm, was to look at temporary policy changes. Okay, so which means again, I'm going to assume sticky prices, and instead of just focusing on monetary policy, I can also think about fiscal policy now. If the government decides to change taxes, for example, through tariffs, import tariffs, or there's tax cuts, or if there's a government spending project, that can all be analyzed now to see how it impacts exchange rates and output in this AADB schedule graph now. All right. So let me tell you again, brief summary. We're focusing on the commodity side of the equations. We're still, when we think about short term, we're going to think about sticky prices, right? So, and also it's also important to note that we're also assuming that the country that we're analyzing has floating exchange rates, meaning that no manipulation, no pegging, no currency pegging, etc. All right. In certain policy changes, we can assume that PPP can eventually hold, but for sure, the short term in which prices are sticky and slow to adjust, PPP will break down, obviously, because Q will change, right? So that's important to note that the entire mechanism in which E can influence Y is through the change in Q, right? That's the critical assumption. As long as we have sticky prices in which Q can change, then we can have an output effect, right? All right. So I already talked about this. Summarize of DD schedule, summarize of A schedule, financial markets. So this is money market and foreign currencies, foreign currency markets, foreign currency returns, and then DD schedules just give you aggregate demand equaling aggregate supply. Okay, and then we will try to impose PPP when we can. And you'll see that it's not always possible. For monetary policy, as you will give you a preview, for monetary policy changes, we can indeed impose PPP in the long term. Okay? But for fiscal stuff, it's impossible to make it true. So that also tells you that fiscal policy has distortionary effects on long-term real exchange rates. Okay. All right, so before showing you the graph shifting graphs and stuff, I want to just give you all the possible changes you can imagine and see how things change for each schedule. So here's the schedule for DD, right? You know how that is. Here's a schedule for AA. Again, it's just the equilibrium equation. The question that should be on your mind is, all right, when does the graph shift, first of all? And if certain variables changes, does the graph shift left or does it shift right? Right? That's what you should be thinking on your mind. So this graph, this slide here is what you should either memorize or walk yourself through it to teach yourself how to figure out how the graph changes. Right. All right. So let me walk you through maybe one or two of these bullet points for the AA and DD schedule so that you know how to shift the curves on your own. All right. So let's just do this is E versus Y. This is DD and AA. Okay. So let's do the first one. So suppose we have a starting point and let's do an increase in I, right? So we know, first thing to note, right? I is not on any of the axes, right? That's the rule of thumb. If there's a variable change that's not on any of the axes, then most likely you're going to have to shift the curve, right? That's a rule of thumb. So in this case, suppose there is an increase in I, just for the sake of demonstration. So how do you think about this? Well, look at this equation. Let's hold E constant. So let's just say it doesn't change. If I increase I, that's going to have a positive effect on aggregate demand. So I should expect D to increase. There's going to be a shortage, right? If I can't change E, then the only other parameter that's free is Y. So therefore, Y has to increase in response to I. Correct? Does that make sense? So I'm gonna say that again. You start with this equation. You want to change I. I is not on any of these axes, and we're holding E fixed. If I increases, aggregate demand increases. That's going to create an inequality in which there's a shortage. Keynesian economics tells us demand creates supply. So more demand, supply is going to be eventually created. Y is the only other free parameter, right? Because that's one of the axes. And so we should see an increase in Y for a given E. So in other words, fix E. I'm going to fix E. So E is this line. If there's an increase in I, that this level of E should experience an output boost. So this point should jump up. Agree? To this point here. In fact, that choice of E was arbitrary. I could choose any E. I can choose this E, right? For any E, increase in I, aggregate demand increases, output has to increase. So this point will also jump. So every point on the schedule jumps. So the entire DD curve shifts east, right? D prime. Sorry, my lines should be intersecting these dots, but they're not. Anyways, like that. Okay. All right, so I chose I as for demonstration, but the logic goes through for any other parameter. Maybe instead of increasing investments, maybe government spending increases. The same logic. Government spending boosts aggregate demand, out supply will meet demand, and so every point on the original DD curve will shift east, right? I wrote CA here, meaning it could mean that maybe there is a change in consumption patterns in the country, right? So maybe the entire current account function is different now because people are just like, I'm gonna buy imports no matter what, right? They love imports now. In that case, then that could also change the way in which aggregate demand changes, right? So increase in I, G, CA, or P star, right? Because increase is a positive effect, right? This is positive, sorry, this is positively related with D, I, G, and Q are all positively related with G. So increasing any of these parameters will shift the curve to the right. Okay. If you decrease any of this stuff, it will shift the other way. Same logic as before. Make sense? All right. Let's do the AE schedule to be complete. So how do you shift curves, shift the AA curve? Well, instead of fixing E, it's easier to just fix Y. Right, so given Y, let's just, for demonstration purposes, let's just increase money supply, MS, see what happens, right? So let's draw a graph here. A, E. Starting point. Why not? Okay, so given a Y, so let's just choose this Y here, okay? If I increase MS, the left side of this equation will be greater than the right side. If I fix Y, which is what this is saying, given Y, so I can't move this. The only other free parameter I have is E because that's the other axis, right? It has to move in such a way that increases L, right? Because everything else is assumed constant. So how do I increase L? Well, I can decrease interest rates, right? Decrease R, but that would require me to increase E, right? So what that means is that if I increase MS and hold Y constant, then I should observe an increase in E. So holding Y constant, if there's an increase in the MS, E has to increase. So this point jumps up to this point. In fact, every point on the AA schedule has to jump up because I chose Y arbitrarily, right? So the entire AA schedule shifts up. Okay, and in fact, I even tell you the direction here, right? So MS, R star, E shifts the A schedule upward. An increase in P or L will shift the A schedule down or south. All right, so now you have rule of thumbs. You can now look at this slide and just tell me how the curve shifts, but I like to just think of it from intuition. So in any case, this is a starting point for you to, start thinking about how to analyze certain variable changes in the equation you have. So let's analyze the first thing. Let's look at a temporary change in policy in which there's a money supply increase, okay? So the other stuff, of course, we're gonna analyze soon, talk about government spending and taxes. And for now, let's assume that domestic policy has no effect on foreign interest rates or price levels. So just assume that these parameters are also constants, not dependent on domestic countries' policies or variables. Okay, so let's do this. Temporary monetary expansion. For sure, PPP will fail, right? Because Q will change. Q in fact will increase, right? So for sure, right? Relative PPP is going to be violated. And the mechanism in which there's more exports is because domestic countries' goods and services appear more attractive, more competitive, cheaper, right? And therefore, that's gonna boost output. That's the story here. So let's go ahead and analyze this, and after the analysis, we can take a break. Okay, so this is short term, okay. Let's begin our analysis, just like the stuff in the midterm. We have a starting point, equilibrium point. This is Y naught. This is E naught. So a temporary monetary expansion says there's an increase in MS. So that the relevant equation that's going to be impacted is the MS over P equals to out. So an increase in money supply, sticky prices, left side greater than right hand side. We have to increase L somehow, and that's only possible for a given Y, all the constant, right? E is the only other free parameter. E has to move in a direction that decreases interest rates, so E also increases, right? So that means that every point on this A schedule increases. So upward shift. Maybe I won't draw it so dramatic, just like this. Sure. Here, and if you are not so much concerned about the story, you just have to conclude that this is your new equilibrium because market clears everywhere, only here. But let's walk through what's going on in the background. All right, so given this, we have an increase in E, right? Which is what we found. That E is going to feed back here, pushing up Q, right? And we'll push up E, and we'll make this inequality here, and eventually output would increase. So we are increasing output, right? Output's increasing this way. But as output increases, this feeds back into here, right? Higher output means higher liquidity demand, which means inequality this way. We need to find some way to decrease that. That's only possible if interest rates are higher. Interest rates are higher if E decreases, right? So, sorry, let's see. This should be moving from here, sorry, this way. Yeah, so E is decreasing from up here, not down here. Right, E decreasing, Y increasing until there is a stable point here, right? So the gap between this line here and this A schedule and this line here, right? As long as there's a gap, that means Y wants to keep moving upward. And so we're moving E downward and Y to the right. As long as, so Y wants to keep moving to the right as long as this E is greater than this E naught, right? And so this is our short run. Let me say that again, and then we'll take a break. We started with a starting point. This is our initial equilibrium with market clearing everywhere in the financial markets and the real economy. We have a external shock coming from a central bank deciding to expand their balance sheet by printing money, like buying assets, right? They print money to buy stuff. When you print money, interest rates fall, exchange rates go up. So an increase in interest rates. So that means that A schedule shifts, right, for sure, because holding Y fixed, every point, every E must be a higher level, right? So the A schedule shifts up. But that higher E will feed into aggregate demand equation, boosting exports, right? As long as the E double prime, this new A schedule, is larger than E naught, right? Every point, the E's corresponding to the DD schedule. As long as there's a gap between this line and this line, output wants to keep moving to the right, right? Because there's a higher Q. Q is still higher than before. So that keeps happening until no more Y wants to be created, right? Y doesn't change anymore. And if Y doesn't change anymore, then we're always on the A schedule anyway. So we're gonna clear markets everywhere. A schedule is always clearing. I mean, financial markets are always satisfied, but it's only when we're on the DD schedule uh, when Y stops moving, right? Okay, so now you see what monetary policy entails in this schedule, and we will talk about fiscal stuff after the break. All right, so let's meet up in 10 minutes. If you have questions about midterm, you can come to me now. Uh, yep, all right, talk to you in 10 minutes. Thank you. All right, let's finish up today. So the mechanism in which fiscal policy has an impact on output is a bit more complicated than the monetary policy uh, method. So to highlight the sequence, logic sequence for monetary policy again, the idea is that if you undermine or devalue your currency, that basically increases the relative price of goods and service goods produced abroad, which makes your exports more attractive, right? And that's the way to create incentive for other countries to buy your stuff and boost output in the model we are working with. For fiscal expansion, the effects are a bit different because your currency actually doesn't want to depreciate. The home currency actually wants to appreciate because of interest rates rising, right? So if we recall from the short-term model, what happens when there's an output effect from Y? That actually increases interest rates, right? And pushes a downward pressure on the spot exchange rate. That downward pressure, unfortunately, actually undermines your export competitiveness, right? So remember, in order for exports to work, in order for exports to have an additional impact because of exchange rate, you must have a positive effect on the current account from Q. But for fiscal policy is different, right? Because E wants to go down, which means that export actually becomes less attractive than before. So under floating exchange rate, fiscal expansion tends to be less preferred because of this side effect. So the side effect has a name, it's called the fiscal crowding out effect, right? Meaning that as you implement fiscal policy, the appreciation of the home currency actually crowds out your export competitiveness. And we can see this in the model that we have at hand because interest rates starts to rise, and that's going to push downward pressure on E. And so you'll see E dropping, yet output still increasing, but it won't reach its full potential, right? Because the exchange rate is going to change, right? So let me show you that now. So a fiscal expansion typically is two types of variable changes. One is an increase in G, right? That's just a government decides to buy a new building or you create a new healthcare service, something like that. So that's just spending based from the government. The other type of fiscal expansion is through tax cuts, right? And so it's a minus T, but not entirely all of minus T because part of that taxes won't go towards consumption. Only the consumption part goes towards expanding output. The rest is saved, right? So I will write a lowercase c to indicate that I'm talking about a decrease in the consumption portion of the tax cuts in which people spend their money to buy stuff, right? To increase output, right? So I want to make that clear. All right, so two types of fiscal policies in general. One is an increase in government spending, and the other is, let me just change this minus sign to a decrease to indicate that I'm talking about tax cuts, right? That's a fiscal expansion. I'm putting more money in the hands of people, but again, because people save, only the consumption part of the tax cut will go towards output. Okay, so let's analyze this. So you probably should have guessed that in this scenario, I won't be touching the AA schedule, right? The first thing that responds to the fiscal expansion is going to be a change in the DD schedule. So let's draw schedules, initial schedules, DD and AA. And if you want to pull up the previous slide, you can, but I can tell you right now directly what's going to happen by just looking at the formula. So looking at this formula, if we have an increase, so what we do is we hold E constant, right? That's the thought experiment. We hold E constant and we decide to increase G, for example, that's going to increase domestic or aggregate demand. Aggregate supply is created to meet the demand. So what that tells me is that for any E that I choose, there must be a higher output level if there is a higher G, right? And so this point must shift to the right, and so the entire DD schedule shifts to the right or east. Okay, so we're here. We want to go this way, like E wants to go this way, right? But as you can tell, if it's moving on to this point here, it's not going to be in equilibrium, right? It's going to be off the AA schedule, and that's a no-no, right? Carry traders will push it directly onto the AA. So actually what's going to happen is the following. So let's look at MS over P equals to following. Right? And so if we want output to increase, this is gonna put upward pressure on L, creating an inequality. To restore equality, we want to push L downwards. That means R wants to increase, and R increases only if E decreases. So E wants to move downward, right? I mean, we're just moving, what I just told you is the relationship between E and Y, right? On the A schedule. So we want to move downwards, right? But this point here, this E, this output level, right? This output level is not happy, right? It's not happy in the real economy because it wants this E, right? On the DD schedule. So this E prime will always be higher than this E double prime on the DD schedule, right? And so as long as this E prime is higher than this E double prime, then output is going to keep increasing. But E is appreciated, right? Until no more Y wants to be made, right? So this is our old equilibrium, why not? And this is our new one, why? So let me say that again. We were here, nothing happened yet. Government decides, hey, let's, give everyone a tax cut. Cool. Tax cuts going to decrease T, which means disposable income increases, which means so aggregate demand is going to increase. Y is going to want to increase, right, over time. Increases in Y tells us that E has to decrease, meaning we're moving along the A schedule. And as long as so for each of these output levels that's lower than Y prime, that E, equilibrium E on the A schedules is going to be always higher than E double prime for the combination of E double prime and Y on the DD schedule. As long as E prime is higher than E double prime, output wants to keep increasing, right? Because higher E, right? Higher E for a given Y, output wants to increase, right? So output increases, E further declines, E prime is still greater than E double prime, output increases. But there's a side effect, right? Because it's not reaching its full potential in which E stays constant. If E was constant, I can actually get this output here, right? Y double prime. But it's not achieving because of the appreciating effects from domestic currency demand, right? Increased demand for domestic currency. So I hope you see that, right? So all else equal, right? If I can hold my exchange rate constant and I do government spending or fiscal policy, the full impact of the fiscal policy, all else equal, is Y double prime, right? But that output can't be achieved because the exchange rate is depreciating, which actually undermines export-import competition. Right? As we move along the A schedule, E has to decline in order for output to increase. But as long as the E on the A schedule is greater than the E double prime on the DD schedule, output still increases because Q is positive, right? It's different than before. Q is different. It's higher. Higher Q means higher output, means higher Y, et cetera, et cetera. Okay. So takeaway, under flexible exchange rates, monetary policy is very effective because when you depreciate your currency through creating money supply, you can achieve essentially the full potential of output, right? Whatever is the full potential. In fact, it's amplified because E is depreciated over time, or because of change in money supply. In fiscal policy, there is a crowding out effect because of this currency, domestic currency strengthening, and that undermines export-import competition, right? If so, the benchmark, of course, is if we hold constant. If we're able to hold the exchange rate fixed, then output, the full potential of fiscal policy is realized, right? Y double prime. But that's not possible here because E is getting stronger, and that undermines export-import competition. Make sense? So you can kind of already see like the conclusion here for permanent policy, right? In a permanent case, we have an exaggeration of this essentially because changing expectations is going to kick the A schedule really, really high, right? And that's really good for export-import competition. But in the extreme case, you can see this crowding out effect completely wiping out any sort of output effect. So I'm going to show you that in a few minutes, but hopefully you can already see that, right? If expectations change so much that E also moves in the same direction, downward, it could completely push the A schedule to the left, which eats up all of our output, right? Okay, so before talking about permanent stuff, I want to talk about a little bit about practicality of doing this stuff. So in order for you to have effective monetary or fiscal policy stuff, so the question you should be asking is, when would you want to do this? Okay. A government or central bank typically wants to do this if they want to defend themselves against a potential recession. But there's a problem with this because you have to be able to time everything correctly, right? So first of all, there's a timing of when the recession is coming about, right? If you think it's coming, but you implement it, you can make your currency weaker than you want it to be, right? That's a problem, right? The timing of when the recession comes. The second problem is how long the recession is going to take place, right? How long it's going to last, in which case you need to figure out when to unwind when things are, things are recovering. So you can, so this is what policymakers are thinking about all the time, all right? And that's why this stuff is all relevant. Okay, so yeah, time lags and identification of the shocks and their duration, and time lags and implementation of the policy. Yeah, so sometimes policies take some time to be fully realized, and that's also a problem. All right, and I already kind of explained this. Effectiveness of monetary policy is, for the most part, better for flexible exchange rates. But of course, if you do it wrong, you can just get inflation, right? That's the downside. Expansionary fiscal policy is problematic because, well, twofold. One is because there's a crowding out effect from the currency getting stronger and undermining import-export, but also may crowd out investments. So we didn't talk about investments depending on other stuff. So here, I and G could be dependent on each other, but in any case, you don't have to worry too much about this. Just note that expansionary fiscal policy is problematic because of the current account is being undermined, right, from the strengthening of the currency. All right, so let's talk about permanent policy changes now. So here we have E hat E also responding, right? Also responding now to the monetary expansion. So we have two effects: increase in MS and increase in E hat E in the short run, right? So in the short run, this is what you have to talk about. In the long run, we need to talk about prices responding, right? But E hat E is still present. That's what we need to analyze. Okay, so that's gonna be a bit complicated, but we'll go slow so that you understand everything that occurs step by step. And as usual, we're going to assume that forward price levels and interest rates do not depend on domestic prices or domestic policy changes, right? They're assumed to be constant unless otherwise specified. Okay, so I'll talk about the summary later. So I think you just want to see what happens, right? So let's go ahead and see. So as usual, let's do a aggregate demand curve, aggregate supply curve, starting point. E naught, Y naught. This is DD and AA. And then the equilibrium equations that it represents. And this one is the money market along with UIP. So as I mentioned earlier, permanent implies two effects on the AA schedule, right? This one, increase in MS, as well as increase in E hat. So let's think about how the curve shifts, right? First things first, we have increase in MS, which makes the inequality like this, right? And then we have an increase in E hat E, which means that this increases, which means that interest rates increases, which means that L decreases. So the inequality becomes larger as a result, right? So increase in MS, increase in E hat E, the gap between the left side and the right side has enlarged much more than before, right? Temporary case. So which means that E needs to move to address both of these effects in the short term, right? So there must be a amplified effect on E. So E has to undo this. So that means E has to increase, right? To cancel out this, as well as to cancel out this. So I'm gonna write two arrows here to indicate that it's gonna be a super jump. So every point jumps up really high. Let's do it here. So maybe up here. I'm gonna write AA prime to indicate that's the effects coming from the increase in MS and also the increase in E hat E. So I hope you see that E hat E, E must increase, right? Doubly so or more so than usual because MS is increasing as well as E hat E increasing. So it has to wipe out the increase in E hat E as well as the increase in MS. Right, and we chose Y arbitrarily, right? I said, I didn't say Y, I didn't pick a specific Y, I said any Y, right? Any Y I choose, there must be a higher E. Right? So every point jumps on the previous A curve. Right? Make sense? So this is our short run. So hopefully so I'll walk you through the logic again, right? For this given Y, this point jumps to this point because financial markets, right? Equilibrium. So we're starting with this point here. Maybe I won't write this down. It's gonna be crowded. So anyways, we're at this point here, okay? At this point, this is higher than this point. This is the equilibrium exchange rate for this Y on the DD schedule. But if our E, this E is higher than E naught, that means the Q is increasing, has increased for this output, and demand is increased. And so eventually we should expect the Y to increase. right? So we're moving along the AA schedule, and as Y increases, E is going to decrease, right? Because that's the negative relationship between E and Y on the AA schedule. And so in the short run, we move from this point all the way down to this point here. Right? So that's the same mechanism, right? I just explained the short in the temporary case. All right. Comments, questions on short run mechanisms? All right, long run. Now, in the long run, the AA schedule is only reflecting change from one variable, right? Because prices has changed to match the change in MS. And so this variable here, as if it didn't move, right? Right, because in the long run, prices will increase to eliminate the increase, proportional increase in MS. So MS over P has stayed the same as usual, right? As if before the shock. And so the only thing that has changed, that persisted from the short term to the long run, is the increase in E hat E, correct? And so that's just a schedule that's shifted like this, right? Some line that's only reflecting, right, the change in expectations and not anything else, because interest rates have gone back to normal. MS over P is the same. And so AA schedule is now only reflecting the expectations change. So in the long run, what's happening is this point shifts down here, right? Or this output, right? Y, right? Now, all else equal, right? Suppose we didn't change the DD schedule yet. We haven't changed the DD schedule. It should. And you should know that it should, because we said P changed. In fact, it changed for AA schedule, so that's why it looks like this. In any case, from this point on, we have a gap between this E, whatever this E is. I don't know what it is. Could be below or above E naught. It's just arbitrary. It's based on what I drew. Okay. So E prime is greater than this point here, right? Or below. This point is below this point, right? And this as if Q is decreasing, right? Because the point on the A schedule is for this output, right? It requires this level of exchange rate for the DD schedule, but it's not, right? It's not this one. It's on here now. So a lower E than the required equilibrium E for the DD schedule means the output's gonna contract, right? So we're moving this way now. Make sense? Because as Y decreases, E is going to increase, right? Negative relationship on the A schedule. So all else equal, we're going to approach this DD schedule. I mean, the DD schedule here, right? But we're not done yet, right? We're not done yet. Because in the long run, P is going to increase. And guess what? P is here, right? So as P increases, that's going to decrease Q, and that's going to further decrease output. Right? We've already factored in the price change for the AA, right? You agree? We've already, AA is only reflecting one thing, change in expectations. MS over P, P has already adjusted, right? For the change in MS. So this ratio was the same as before the policy shock. We're moving along the AA schedule here because output is contracting, right? And so E is increasing, Y is decreasing, and it feeds back until we're on the DD schedule. But DD is going to also shift, right? Is going to want to shift this way. You agree? Because decrease in P, decrease in P, increase in P decreases Q, decreases Y, right? Or D, right? A lower D means that Y will also decrease. So that means for any E, if P changes, if P increases, DD schedule wants to shift to the left, right? And I want to explain to you that it will shift all the way here if we impose relative PDP. So this is going to be the final equilibrium in the long run. I'm going to write LR here. And this is going to be E. Let's just write E. And this one is E prime. Maybe it's not that one. This one. This one's E prime. Now it should be clear, right? So why is it here? Well, in the long term, we proved 2 weeks ago that E traces P, right? Meaning that however inflation evolves, right? However inflation evolves, determines how E evolves, right? Oh, pi E minus pi E star. So P is decreasing, right? As P decreases, that undermines output, which means that we're moving this way, right? As output decreases, E increases, but we're going to stop eventually. When? When do we stop? When E changes just enough to cancel out the change in P, right? That's what this is saying, right? And the long term, anything that happens to P, E is going to do the same thing. And that's only when Q is constant, right? No change in Q. And that's precisely when EP star or P, when E has changed as much as P, then Q, it does not change anymore, right? And that's precisely where output, total output is 0, right? It went back to normal. Right? So it went from Y naught to Y prime and then back to Y naught, right? When we impose the long-term condition. All right, let me say that all again. So our starting point is here. This is the initial intersection between the DD and AA schedules, right? To analyze, what we do first is we analyze the short-term effects. That means hold prices sticky, and we change things that must change before prices respond, right? That's expectations and money supply. These two things will impact the AA schedule specifically. And based on the previous slide, right, if we increase MS and we increase E hat E, then the entire AA schedule is going to shift really high, right? More so than if you only respond, more so than only responding to MS or only to E hat E separately or individually. The combined effects gives you an amplified effect. So our short-term equilibrium is up here, right? All else equal, assuming the DD schedule doesn't change, right? The way it works again is to think about who responds first, and then the real economy adjusts itself over time. So here we jump from here to here, and then realize that the E is too high, right? Compared to the DD schedule. And so as long as the E is higher than what's required, output wants to increase. Output only stops increasing once we reach the DD schedule, right? So we're going from this point all the way down to this point. So this is our short run equilibrium. Done, right? That's the short run stuff. Now, the long run. The long run means that any change in money supply, prices will increase proportionally, right? So on the AA schedule, it's as if the left side didn't change at all, right? So if we were to incorporate the long-term effects from prices becoming flexible and responding to everything, then this ratio didn't change at all. The only thing that did change, therefore, or persists in the long run is this increase in E hat E. That's why the upward shift in the A schedule is muted now, right? It's not all the way up here, it's just up here. Make sense? So going from this point to this point, again, realizing the gap between E, the required E for equilibrium for the DD schedule, and the actual E in the financial markets, that pushes output downward and E upward, right? Based on the negative relationship between E and Y in the financial markets. So Y wants to move towards the origin, and E wants to move upward. So we're moving along the AA schedule up to this DD schedule. Okay, we haven't changed the DD schedule yet. Okay, now the DD schedule will obviously change because, as mentioned earlier, prices have increased because of changing money supply, and increase in prices is going to push the real exchange rate downward, which pushes down the current account, which pushes down demand, right? And then that's going to push down output, right? Contraction, because demand has shrinked. So because we held E constant in that sort of analysis, you have to translate this effect as a leftward shift of the DD schedule. So the entire schedule shifts to the left. So the question is now, how much does it shift, right? So how much does it shift can be decided if you impose PPP. So if you impose PPP, that's this thing, right? Expected depreciation of the home currency is equal to inflation differentials. Then any change in P must also be any change in E, right? If there's a change in P, E has to evolve the same way. So that's precisely when what? Change in Q is zero, right? No change in Q. And when there's no change in Q, there's no output. So we're back at Y naught. And that's precisely where the DD prime intersects with the AA double prime at Y naught here. No output change. We're back at Y naught. And everything I showed you here is consistent with the short-term overshooting thing, right? So we have E naught going to E prime, going back to E double prime. Everything's the same, right? Everything looks the same. But now we can see the output trajectory, right? Because of permanent monetary expansion, we have a big effect on outputs, but as prices eventually catch up with the change and money supply, all that output stuff will be wiped out, right? So it's only temporary, right? Because prices is what real things are based on, right? So if you have sticky prices, we get an output, but in the long run, it doesn't matter because all we've just changed is the how much money is in circulation, right? All right. Comments, questions, confusion. So I think the hard part, I hope, is just this trajectory from this point here to this point, but I think uh if you understand, this, right? If you understand this, this tells you how much the DD curve will shift, right? For sure, the DD curve will shift, right? Because there's an increase in prices, right? For sure. So if you go back to that slide, right? The rule of thumb slide. If I increase P, DD shifts west, right? For sure, it's going to shift, right? The question is how much? And if you oppose the PPP, it must shift precisely back to Y naught because that's when Q, delta Q is zero or Q is constant, right? Because E has increased as much as P. And therefore it's as if Q didn't change at all, right? All right, so I combined the long term and short term together. So I hope it's not too confusing, right? So the short term is just this point here, DD doesn't change. A jumps from A to A prime. Long term is A prime to A double prime, and then D shifts to DD prime. So the long term is here. So we have an elevated exchange rate, right? And also the same output as before. Whereas the short run, we have an actual output effect because of sticky prices and an amplified exchange rate here because we have expectations also changing. All right, that is not the most confusing thing, okay? So the next thing I want to talk about, which you probably could have guessed, is permanent fiscal expansion. This is going to be quite a confusing explanation, but the takeaway is the following, as you kind of already guessed from this graph here. This crowding out effect can be disastrous if E hat E also changes, right? But it's going to change in the opposite direction. If somehow expectations are also reflecting this permanent fiscal expansion, but in the opposite direction, AA schedule wants to move as well. And if AA schedule moves down by a lot, it could wipe out any output effect in the short term, right? This is not the long term, right? No price effects. This is just, you just have nothing, right? But of course, it's a special case, as I will demonstrate to you now. So let me tell you how to prove that special case in which output is completely wiped out. Yeah, okay. So let's do it. Let me show you what I mean first. So let's do the short-term effects of, so let's do, it's gonna be both, okay? So short-term and long-term effects, permanent fiscal expansion. Permanent fiscal expansion just means we are increasing G or decreasing CT, again, consumption part of tax cuts. But we also have a decrease in E hat E, right? Again, it's in the opposite direction because in the temporary case, we have a strengthening of the currency. So in the permanent case, people expect that the currency will appreciate, right? Home currency will appreciate. So let me show you what I'm talking about. So here is the schedule. Schedule. Let's see. Okay. All right, so if you recall the temporary fiscal expansion, what happens is that the DD schedule shifts east, right? Or to the right. Maybe we choose this point here because it's probably most intuitive. Hold E constant. If E is constant, G increases, aggregate demand increases, output increases eventually. So every point on the original DD schedule has to shift to the right. So be it, right? It's here. Cool, right? All else equal. We should, be here maybe, right? Well, guess what? We have expectations also decreasing. So decrease in E hat E will lead to a decrease in interest rates, which will increase L, right? So it creates this inequality. To restore it, we need to undo it, undo the decrease in R. So that means that E has to also shift down, right? If he shifts down, E also has to shift down. So for any Y, so I choose any Y, let's choose this one. Y naught, and E naught. If I choose this Y, then E has to shift down, but how much, right? Does it shift all the way down to here? Or does it shift somewhere halfway? Right, that should be your question to yourself. I'm going to tell you that for a special case in which we are in the long-term equilibrium, which means that E eventually equals our expectation. So let's suppose that this is true, okay? I want to prove to you that this A schedule will shift all the way down here, such that we get nothing. Here. Okay. And you can already guess why this is true. Because in the short term, in the temporary case, we have this crowding out effect because our currency is getting stronger. So if the temporary case were here, right? But if it's permanent and under this special case, I'll show you the crowding out effect doesn't stop. It just keeps going, right? It just keeps crowding and crowding and crowding out until no output whatsoever. So as I will prove to you mathematically, in this special case, this is our short run / long run equilibrium. All right, you're going to be asking me why. Well, let me tell you why. To prove this, we have to rely on something in mathematics called proof by contradiction, meaning that we're going to assume that there is an output effect and show you that that's going to lead to a contradiction. And therefore, our initial assumption that there is an output effect is wrong, and we must conclude that there is no output. Okay. All right, so first things first, in this special case, so if we're starting in the long-term equilibrium, that just means that E hat E eventually equals to the spot rate, and let's just assume that R equals R star. Okay. All right, so if there is an output effect, what does that look like? So if we look at this graph here, if there is an output effect, that means that the A schedule did not shift down enough, right? So hypothetically, right, it means that maybe the A schedule shifts just a little bit, right? So we still get something, right? So I'm going to put a question mark. So if we want something, we still want something, then the intersection would happen somewhere between this point here and this point here, and we get some output Y question mark, right? That's the question. Does the AA schedule shift down just a little bit, somewhere between this point and this point, such that we get something? And does that something lead to a contradiction, right? All right, first thing is to suppose there is an output effect. So suppose this is true. That means that the change in E is going to be absolute change in E is going to be less than the change absolute change in E hat E. Right? This is saying that despite expectations changing by some amount, the decrease in E is small, right? It's not 1-to-1, it's something small, right? That's how you can get an output effect, right? That's the first assumption. So if I were to write that as a difference, then that's like saying that E hat E, the change in E hat E minus E. So this decreases by, so remember they're the same originally, right? They're the same originally. Okay. If E decreases by a lot, and this decreases by a little, then the difference is a big number, sorry, a small number minus a big number, right? Because this one's really small, like say it's 0, right? And this one changed by something smaller, say it's 1. So 0 minus 1 is negative. So let me go up here. Suppose that the short run increases and E drops initially less than the expected long term, right? That's the first step. That tells us that E hat E minus E, this is a big number, this is a very small number, is negative, right? Because E hat E has decreased more so than E. So imagine they're like 5 and 5. This decreases by 4, this decreases by 1, right? Then it's going to be a negative number. Okay, cool, right? So far, so good. So then the short run, R is greater than R star because unmet real money demand. So between the short run and long run, E must depreciate towards E. Yes, okay, so if this is true, right, then R equals R star plus now E hat E minus E over E, right? Which means that this, right? Because this is a negative number. And R is going to be greater than R star. So let's see. Maybe another way to see this. If we have an actual output effect, right? So recall this model, right? E versus R versus L, right? If Y increased, there's an output effect. So let's just put a Y prime here. All else equal, interest rates increase. Agree? So R, the new R, right? The new R prime is greater than R, it's greater than R star, which tells us that in order for UYP to be true, E hat E minus E must be positive. So let me say that all again, all right? All right, to prove that this is the equilibrium, okay, so the conclusion is obvious, right? This and this cannot both be true, right? It's impossible, right? Something can't be less than 0 and also greater than 0. So our initial assumption that there is an output effect is wrong, correct? So we must conclude that output change is 0. So let's start over and see what's going on more precisely, right? So when this, we start here, initial equilibrium, there is a fiscal expansion, which means the DD curve shifts to the right, right? You can think of it as a tax cut or government spending, holding E constant. Every point on the DD schedule has to shift to the right. So This is simple because we did the temporary case and that's what happened. In the permanent case, it's different for AA, right? It's going to shift down, but is it going to shift? How much down is it going to shift, right? And I'm going to tell you that I'm trying to prove to you that it has to shift down enough so that the output effect is zero, completely crowded out by the appreciation of the home currency, specifically in this special case in which E hat E is equal to E. Okay, suppose we're in the very, very long term and the exchange rate matches our expectations. Okay, nothing else, right? Assuming there's no other shocks, right? So in the long term, this must be true. So in the very long term, if this being true, and we want to prove this, we prove it by contradiction. So we make an assumption and see where that assumption leads us. If it leads us to a contradiction, then that initial assumption is wrong, and we must conclude the opposite, right? The complement. So suppose now there is an output effect, which means that the AA schedule did not shift enough, right, to wipe out or crowd out the output. So it just shifts down, let's say, a little. That means, translated in terms of E and E hat E and D, it means that the exchange rate, the nominal exchange rate, didn't decrease enough or the same amount as the change in expected E, right? So that's what this sentence is saying. Suppose the short run output increases and E drops initially less than expected long-term E. So you get an output effect, but that's only possible, according to this graph, if the change in E, right, from E naught to E whatever, is enough to wipe out this Y question, right? Or this Y point, this Y. So if that's true, then the expected depreciation, right, based on our understanding of the change, the decrease in EIE and the decrease in E, is going to be a negative number, right? Because E hat E has decreased by some amount, but E only changed a little bit. So a very small number minus a bigger number is going to give you a negative number. So this is our conclusion based on the graph, right? If an output is able to be possible, then this must be true. Expected depreciation is negative. All right. Now, looking at the short-term model, right, this model here, if we have an output effect, that means the liquidity preference line is shifting away from the origin, which means that interest rates are increasing. If interest rates are increasing, that means that there is an offsetting expected depreciation of the domestic currency that's positive, right? Because R has increased, carry traders come in, and that means that to restore UIP, they must believe this, right? Expected depreciation is positive. And E must depreciate towards E, right? This must be positive. But these two things cannot coexist. They are contradiction. They're opposites. So that's what this symbol means, contradicts. So we must conclude that no output, no initial output, therefore, no initial output. Of course, again, special case. But that it highlights, right? It highlights this crowding out effect that's very pernicious and bad, right? In terms of its efficiency of, its effectiveness of creating output, right? Because of the crowding out effect is really undermining the policy action. Make sense? So in this graph, short-term effect on permanent fiscal expansion, I'm combining both short-term and long-term now, because if you do anything like this in this special case, you will get nothing. All you get is a stronger currency. And based on this arrangement, Q has changed, right? Delta Q is not equal to zero for sure. So PPP fails in both the short term and the long term for fiscal expansion or fiscal policy in general. Okay. So I can repeat everything again, but I think twice is more than enough. So let me summarize a bit. Yeah, so effectiveness of economic policy intervention. So under floating exchange rate, so again, we're not talking about Hong Kong, we're not talking about China, we're talking about like UK, US, Australia, where they don't intervene in the FX markets at all. We find that permanent monetary policy is very effective because expected exchange rate response amplifies the effect on output, right? It's because of the E hat E in combination with increased MS that gives us that devaluation that makes our exports super competitive, right? Because it elevates foreign countries' price level, consumption basket price levels. And so that makes our goods and services more attractive. And so CA that increases E by a lot. And of course, increase in E increases CA and increases output, etc. Right? All that good stuff. All that good stuff. Permanent fiscal interventions are not effective because expected exchange rate response offsets the effect on output. Again, it's the crowding out effect, right? The appreciation of domestic currency crowds out output. And it's especially bad when we're in that so-called long-term equilibrium, right? Where output is completely deleted. Okay. One final comment under monetary policy, PPP can be imposed, right? You can impose it, make everything consistent. It's very nice, right? Very, very, very elegant and clean. Whereas this fiscal policy, you can't make it work, right? PPP is going to be violated and broken. So that kind of also explains why PPP is so volatile. I mean, the real exchange rate is so volatile because fiscal policy is just very, very distortionate. Okay, so that's the end of lecture 6. So I realized I think this is the hardest part of this class. So if you get this, then that's great. You're in good shape. Next week we will talk about fixed exchange rates, and it's a little bit more straightforward. None of this long-term stuff, because under fixed exchange rate, we assume that the long term, the government's going to keep everything the same. So it's going to be easier to understand. So let me summarize a bit. All right, so this is a summary of how to shift the curve. I just rewrote it again and I highlighted the parameters for ease of reasoning. So if you don't want to walk through all that curve shifting stuff yourself, of course, you can just memorize this. So commit to memory, it's fine. But I think, walking through everything yourself, you don't have to remember anything. You just need to know the intuition. I'm very bad at memorizing things. So this is, I wouldn't even consider memorizing stuff. I would just do it once by myself, and then it should be very easy to replicate again and again and again. All right, so that's how you shift the curves. We talked about a temporary monetary expansion. The way to analyze the mechanism and the causation sequence is to always think about moving the financial markets first, right? So for monetary expansion, we move the AA schedule, right? But we always jump to the other AA schedule first, right? Before thinking about anything else. So once we get onto the AA schedule, you'll see that we're out of equilibrium. And because there's a gap between the required E for the DD schedule versus the E on the AA schedule or the new AA schedule, there's going to be an export effect, right? Because Q has changed. With a different Q, exports wants to increase. And as exports increase, E is going to be stronger. And so our final point is when Y doesn't change, right? And that's where markets clear everywhere. Right, that's the general pattern here. So I kind of outlined the feedback here. You can read on your own, but it's whatever I just said, but just a little bit more explicit. Right. So going from here to here to here to here. All right. Temporary fiscal expansion. We talked about this. This one is just you know, shift the DD curve, right? Instead of the AE curve, DD moves to the right because we changed G or changed C, right? CT. And the way to think about this again is to hold E constant, realize that every Y has to increase because the aggregate demand changed, and therefore output has to eventually meet demand. So however, as you increase output, E wants to increase, which is why you move from this point here to this point here along the AA schedule. Again, remember, we're always moving along the AA schedule to think about the mechanism because we're always in equilibrium in the financial markets. So as Y increases, E decreases, and as long as there's a gap, right, gap between the D and the Y, the required E for the new DD schedule is always going to be lower than the E for the AA schedule when we're not at the intersection, and so output keeps on increasing, right? Because Q is higher, Q is positive, right? Changed positive. All right. The hard part is this permanent stuff, right? This is the most confusing part. So for monetary policy, this one, I think it's not too bad because, so maybe I'll show you the picture. It's not too bad because for the AA schedule, for the long-term AA schedule, we try to incorporate the price change already, right? So we don't need to think about this anymore in the long term, right? So from AA to AA prime, that's when we have sticky prices. When we get to AA double prime, prices has already increased to eliminate any change in MS. So it's only reflecting the change in expectations, right? E hat E. So we go from here for the short run, which is, I think is obvious how it's done. And then it drops to here, right? And then given that this point is this E, right? This E is higher than this E, there's going to be contracting forces, right? E wants to increase and Y wants to decrease. And then we're here. Now, the next step in the long term is to think about price increases having an effect on aggregate demand. And we know that the DD curve shifts to the left, right? But how much? Now, if we impose PPP, we know exactly how much it has to decrease. It decreases enough such that the delta Q equals 0, right? In which output is completely undone, right? So we're back at Y naught. That's the intuition, right? We can impose PPP that tells us how much DD shifts to the left. Okay, this is all, and then again, this is all consistent with what you learned up to week 6. There's an overshooting effect. It's all captured in this picture. And lastly, I think the most confusing for everyone is proving that the permanent fiscal expansion is pointless. And it's only pointless, of course, in the special case in which we have R equals R star as a starting point. It's a starting point. If that's the starting point, right, the proof again is the following. We have a situation in which the decrease in E hat E is a lot, right? But the decrease in E is only a little bit. That's how you get an output according to the picture. If that's true, then E hat E minus E over E is negative, right? The second thing to conclude, right, is if there's an increase in Y, the short-term model tells us that we must have R equal to R star plus some term, right? E hat E over E. That's positive. Again, because R has increased, right? R has increased as a result of an increase in Y. These two things cannot coexist, contradiction, and therefore we must conclude there's no change, no short or long-term output effect. That's it. So here's the graph, right? Paradigm effect, the short term, but in the long term, having a short and long term, right? Because expectations has changed. It completely eats away at the output. So 0 output. All right, so that's it for today. The hardest part, I think, is the end of this class, so please spend some time to digest this stuff, because once we're after this hump, next week is super straightforward. And we're done with modeling exchange rates. Okay, and then we'll talk about risk management. All right. If you have questions about the midterm, you can come talk to me. If you haven't picked up your midterm, if you're for this section, it's here. If in your other sections, you can come to me to pick up from the other pile. And I'll see you guys next week.